Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks. And in today's episode, I'm going to share with you the secret, the magical formula of how you make money with technical analysis and stocks. Just kidding. The reality is there's no secrets to technical analysis. There's no magic formula. There's no golden egg. There's no silver bullet. It's really about knowing and understanding how stocks move and behave and understanding that behavior. That's like your friend that always shows up late for dinner. They're probably going to show up late for dinner next week as well. So looking at the behavior, you get to see and understand some trends and patterns. Now, with this, what I want to do is share with you some thoughts and ideas about something that's overlooked. And that's why I like to call it a secret, but really, and the reality of it is it's just something that most people overlook. Of course, when I look and focus on this thing here, and I'm going to share this with you in just a moment, is that you should still take into account chart patterns. You should still take into account volume. You should still take into account the trend, the behavior, the way the stock moves. All these things, they're all working together. But this one thing is probably something that you're overlooking. And that one thing is wide price spread. So that's what we're going to get into today. I'm going to share with you this concept because a lot of people overlook it. They don't understand it. They don't understand the point behind it. They just assume every bar is equal, when in reality, some bars are worth more weight than other bars. It's kind of like, hey, understanding a doji, understanding when a stock is topping out. You're kind of reading some signs and signals, but those things are tough to decipher because they're individual days. Here, when we look at wide price spread, okay, when we look at price spread, it's much more significant. So first off, what is price spread? Okay, price spread, all it really means is from the low of a bar, okay, to the high of the bar, right here, from the low to the high of the bar, it's wide. That's what wide price spread is. This, for example, is a wide price spread candle, okay? Here's another wide price spread candle. If you look at some of these candles over here, these are not wide price spread candles. These are very medium to smaller spread candles. So we're looking for wide price spread candles. And the whole reason behind this is because there's more significance to it. It means that someone stepped on the gas. Someone put their foot, the pedal to the metal, and they're buying a whole bunch of stock. Or in the reverse, if a stock is selling off, they're dumping a whole bunch of stock. So if we look, for example, on a stock like Boeing, okay, and we look at this bar right here, they're dumping a whole bunch of stock, okay? That's wide price spread. So from the top to the bottom, now this one kind of retraced a bit, but nevertheless, overall, that bar is fairly significant. So that means it's important. If you look at Johnson & Johnson, so here's, let's see, J&J, okay, we look at this wide price spread bar. Look how significant that is. That's very significant because all that time for the last 4 months, it's been taking that stock just to get to halfway. It took it 4 months. So that's what we're looking at. It's important because it's a huge amount of energy, right? And all stocks have is a lot of energy. So if you have the pedal to the metal and stocks are going higher, or the pedal to the metal and stocks are going lower, or in other words, you're hitting on the brake extremely hard, it's important and it's something to watch. A lot of people, they try to dissect things like little bars, or what does that bar mean, or what is a hammer, what is a doji. Those things are good to know, and they're good to scan periodically to see and understand indecision, to see and understand when things are topping out, and they're fine. But I believe that more people emphasize those things rather than the wide price spread bars, which are way easier to see and way easier to understand. So when I look at things on a stock, and let's just take Johnson & Johnson, for example, here, when you're looking for any time of a breakout or a breakdown, and let's talk about breakouts in this case, just because breakouts are more common, simply because stock prices naturally go up. So looking at breakouts, when we look at a descending trend line and descending pattern, okay, so here's our trend, here's our channel, and we look at a breakout. Well, initially that first breakout was not very significant, okay? And we compare the wide price spread to the rest of the bars. So comparing it to the rest of the bars in the past, it's not that big of a bar, right? The width, the distance, the height of the bar is not that big. But once you start getting into the second bar and the third bar, the distance, the tallness of the bar is starting to pick up. When you have a bar that continues to pick up speed and goes faster and faster and faster, and you have it on increasing volume, that's a good sign. That's a sign that most people don't pay attention to. They overlook these things, okay? Now, when a stock moves higher, this is what you want to see. When a stock pulls back, let's say, hey, we're pausing a little bit, you want to see light bars, bars that don't have a lot of wide price spread because we're digesting the move. And you can see here now in Johnson & Johnson, right there, those bars are just pulling back slightly, but it's not big, it's not major. That means we're just tapping on the brake. Okay, we're tapping, we're not slamming on the brakes. And then again, as we power higher, we got wide price spread. Okay, again, we come in wide price spread. So if I can drill it into you, the importance of wide price spread, what's happening here is that buyers are stepping up to the plate. When buyers step up to the plate to buy, they drive the price higher. And as they drive the price higher, that means they're going to stick around for quite a while. They're not just getting in and out of it very quickly. It means a lot of buyers are getting into it. And you can pick this on any stock that you want. Anytime you see a significant breakout, okay, with conviction and with stability, it's going to probably have wide price spread. There are some movements where there's not wide price spread and some stocks will hold up fine without wide price spread. But the majority of the time, pick any stock. Doesn't matter what it is. You look at a stock like Apple, okay? You look at any significant move, right? Wide price spread. Look at that bar. That bar is important. Now, does it matter that you got it right at the breakout point? No. You could have gotten in it a little bit later and you still would have been fine. So that's the thing, is that anytime you have a wide price spread bar, chances are things are going to continue to run into higher prices. Now combine that with a chart pattern or resistance or a channel. Combine that with volume. So if you have an increase in volume, like we do in some areas here, then more things line up. The more things line up for you, the more or the higher likely or the bigger the chance of success that you have. So this is what you're looking for. Now, if we're looking for this on the downside, the same concept applies. So if here we're looking for support and the stock is starting to roll over, okay, if this wide price spread starts to pick up to the downside, that's not a good sign for the stock. Instead, you want to get out of it, right? So again, if we have some massive downward movement, chances are you'll continue that follow through. Eventually the bars, the distance of those bars will start to change, the colors will start to change, and that's where you get those reversals, changes, rounding bottoms. That's how they change. It's not just all of a sudden whip back up. Sometimes it is, but oftentimes they kind of cushion themselves. Let's take a look at another company like Amazon here. Okay, so take a look at any breakout here. And you can do this on the daily chart, you can do it on a weekly chart, you can do it on a monthly chart. So look at it, let's say, from a monthly perspective, anytime you see the wide bars, same concept. So if you're a longer term trader, you could look at it on a monthly chart. If you're a shorter term trader, you could do it kind of on a weekly chart. You could even do it on a daily chart. There's nothing wrong with a daily chart. The difference here when you go into a daily chart is sometimes you get some mixed signals because you'll have a few days that might go up and some gap up days. So those could throw you off a little bit. But for example, this would be a wide bar because in reality, it gapped up from here and moved higher. And you get a few little pullbacks, which as a day trader, you have to account, or somebody that's looking at the daily chart, you have to account for these slight little pullback deviations. And then again, a further move a little bit higher. So that's the couple of issues there. So even a 2-3 day chart sometimes will help clear those things up. So compare this range right here. What's the biggest bar? That's the simple way of doing it. What's the biggest bar? Right there. And it's a green bar, it's an up day, and you got big volume. Now, of course, you can make this more complicated if you want to. You can get more specific, you can be very detailed, be very analytical about it. But if you're trying to keep things simple, Do you really have to make it that much more complicated? No, just keep it simple. Keep it simple. Add in a level of resistance. Okay, here is our breakout point. Is there volume? Yes. Is there wide price spread? Yes. Did it break a resistance level that digested for 4 to 6 weeks? Yes. Okay, 3 things all in lineup, all looks good. Things should continue to move higher. And if this happened, well, in that case, the stock continued to move higher, right? You could do it the same way here. Okay, there's resistance, there is volume. Is there wide price spread? Not as much. A little bit on the second day, more wide price spread, but I'd be a little more cautious on that one, right? So it's possible, but you just be a little more cautious. So 2 things line up, maybe 2.5, because the wide price spread is okay, but it's not amazing. But every stock is different. Take a look at, let's say, CMG. Okay, this one had some downside problems. So let's take a look at some downside if you're into shorting. I'll go to the weekly right here. So again, take a look. Okay, here's our support right there, but we already see big wide price spread. So if you take this, what are some of the biggest bars? Just point them out right here. Here's some of the biggest bars we have in 2014, 2015. We have some bars that are very tall, and a couple of them, at least more recent, became red, which means you'll probably get further downside movements. Now we do have support at around 600 in the stock. So if that breaks and you had wide price spread, which you did, stock should continue to follow through. So you had a break in support, that's 1, wide price spread, that's 2, and the third, you got an increase in bearish volume. So that's 3. 3 things in alignment, chances are it's going to continue moving in that direction. Now eventually you'll get counter trend bounces like you did with Chipotle once it hit 400. But you're always watching for, hey, where's the volume? Is the wide price spread bigger in the past? And you have to compare it to, hey, and keep in mind that the bearish days are typically larger down moves than the up days. But if you notice that the stock, as it moves, it starts to stall out as it heads higher, chances are you'll continue to follow and move down. And that's why once you break that initial pattern and you broke it with wide price spread, even though you had some counter trend bounces there from time, that stock still continued to move lower. The natural energy was still down, and it showed you from the beginning. Now, once you get the rotation or the stock starts to roll over, you got your digestion. Again, do you have volume? Do you have wide price spread? And do you have a break in the chart pattern? Yes, yes, and yes. And that's what you're looking for. When you have things that happen and line up 2 or 3 things, you have a higher chance of success. And that's what you want to start looking for, is that most people, they kind of neglect these things. They're looking for breakouts on little things. They're looking, like, for example, let's take Disney here, and we're looking at this 115 level. Well, they're trying to look at it and say, hey, well, it broke by 115.03. Well, that's not really wide price spread. You know, you had a little normal bar, but I'd rather see here in this bar, and in this example, we had a bar going from 113 or 113 to about 115.30. So when you look at that range of that bar's range is about 2.34. However, when you look at a different bar in Disney, we have this green bar, that range is about $8.17, which is just in December. Now, granted, market volatility is different. Those kinds of things do come into play, but still, wide price spread is wide price spread, which means, is there an influx of buyers? And if you just have a stock that's moving, on average, just $1 to $2, and it's trying to break out on $1 to $2, that's not necessarily stepping up with buyers. That's not necessarily stepping on the pedal or the gas. It's just, hey, it's breaking out and it's fine. It could work out, but it's not huge conviction. You might have a little volume, but again, you don't have a ton of buyers stepping up. You have a little bit of buyers, but you don't have a ton of them. So when you're trying to do breakouts like this, it's better to wait for wide price spread. Let's take a look at a little bit of another example here. So let me pick one out here. Let's see, here is one. Let's do, I'm just trying to find one here. we'll go with this one, Altria Group, MO. So this one, even though it continues to move fairly well, and it's doing fairly decent recently, what you want to watch here is that here, my example for you, is that a stock that broke out right here, okay, we're looking at 2015, 2016, even though we had some resistance around November 2015, and then the stock tried to break out, it's not huge wide price spread. We had a little bit of movement and a breakout. We had chart pattern. We didn't have a ton of volume, so if you compare the volume, it's not really there, but we did have a break in price. Price is price. You can't argue, you can't deny price. So we had a break in price, we had a break in the chart, but there was not a lot of wide price spread, which also means we didn't have a ton of volume. So in this case, what happened, as you can see, is we just kind of, as we broke out, we went sideways, and we continued to move a little bit higher a few months later, and then the stock pulled back again to that support level, because that wide price spread was just a small bar. Comparing it to maybe a few months earlier where the bar was way bigger, maybe 3 times the size, that had some more significance. But in our case here, we still had a breakout. We still had a break in the price of the pattern, and we still had movement into higher prices in the future. But did it move really well? No, not necessarily. It still worked out, but the wide price spread was not there. In this case, these things, they can still work out, but you can see that when you don't have that conviction, you don't have that wide price spread, it's just, you got less things in your favor. And with less things in your favor, you have a less chance of success. So here's my final thought, is that a lot of people overlook wide price spread. They overlook it because they're focused on chart patterns, they're focused on attaching themselves to the company, when instead, looking at the energy that the stock produces and the amount of things that could be in your alignment or in your favor is actually a good thing. You're trying to watch out for those things. And if you're driving a car down the highway and you have your oil change, your brakes are new, your tires are new, the car is fairly new in good shape, and it's been maintained and checked over multiple times over the last year or two, then you should be in good shape to drive cross country. But if that car is very old, it hasn't been checked, the brakes are old, the rotors are in bad shape, and you haven't had your oil change done in 100,000 miles, you're probably not going to get very far. So having multiple things in alignment and working together gives you a better chance of success and making sure the trade works out better. And wide price spread is one of those signals that really stands out that most people don't really watch for, and they should be watching for. So I hope this makes a little bit more sense, gives you some insight, gives you some perspective, and some things to think about as you continue evaluating charts and looking at your technical analysis. Thank you so much for joining me in this week's episode. Hope you found it helpful, insightful, and you learned something today. I hope to see you in one of my next videos, courses, or check out some of my upcoming books as well on our website at tradersfly.com. Thanks again, and remember to do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.